What is up, guys? This is Chris with Leveling Up Your Finances, and today we're going to be covering an M1 Finance blog, a guide to investing for the long-term financial wellness. Well, that was a tongue twister, but basically this guide was put out January 13, 2022, so depending on when you were watching this video, things might have changed. However, I doubt it because this is the very basics of investing. That's why it is a guide to investing for long-term financial wellness. All right, let's just jump into it, guys. Again, this is very basic, so we're going to cover over um, the basics, but then we're going to go a little bit more in depth. So you could probably watch about half of this video, and you already know most of it, so you could probably just skip on to the next one. But let's get into it anyways. Investing for the long term can be one of the best ways to improve your financial wellness, build sustainable wealth, and create a future you want. But a major knowledge gap prevents people from opening retirement accounts and investing in the stock market, or, contributing to your 401k. What is that? According to a Standard & Poor's Global Financial Literacy Survey, the U.S. ranks 14th in global financial literacy skills. 14 is not number one. So come on, America. I think we could probably do a little bit better than that. What things we're going to cover, guys. What is investing? Why is investing important? What are the different types of investments? Alternative investment options. 5 steps you can take in investing. Which investing or investments are right for me or you? The pros and cons of common investments, and how to start investing. So let's begin with the fundamentals. What is investing? This is actually the definition. Investing is the intentional act of purchasing assets to generate a profit, grow your net worth, and meet your financial goals. Investments can come in many forms such as stocks, bonds, investment funds, real estate, cryptocurrencies, and artwork. I do like the wine one. I don't know why they didn't add it, but you can also invest in wine, and it's great because you drink it and you're happy if you lose. No matter the method, the ultimate goal of investment is to make more money than you originally put in. No shit. Either you or someone you pay to manage your investments will buy stocks, bonds, mutual funds, and alternative assets in hopes that your money will grow over time. How much money you will make from investing depends on the market as well as your own risk tolerance, your time horizon, investment strategy, and many, many, many other factors. The stock market is unpredictable, and even the most qualified stock market experts are not always right. No, really? So you might be wondering, if the top money managers don't always win, why should I invest? Well, you got to think of it like a garden, guys. Just because you sow seeds today doesn't mean you're going to have vegetables tomorrow, right? Investing takes patience, care, and long-term mindset. So again, investing is different from gambling, day trading, swing trading, speculation, all that fun stuff. That stuff is fun, but you will lose money in it, just like everybody else, including myself. Investing for the actual definition is long-term, and it's to build wealth or generational wealth at that. So those are the difference, guys. Remember, I always talk about that, but here you go. The difference between, it literally says it right here, between trading and investing. Trading is a short-term pursuit of immediate goals. Yeah, you want that money now. You want those profits now. You want that huge percent. You want that hype coin, all that type of stuff. However, on the other hand, investing is a process of building wealth for the long term. Here's a little picture of trading versus investing. You can read it really quick if you like, because my voice and my throat hurt, so I'm going to take a drink. So read that stuff if you like. That Bailey's in my coffee is delicious. Why is investing important? Finances are a major stressor in most people's lives. It says about 65% of adults consider money a stressor. I'm pretty good with money, and it even stresses me out to this day. So let's be real. Every single one of us, especially if you're watching this, I'm pretty sure money has stressed you out at some point. It's a huge thing. So that's why you should invest. other reasons, but you know what I mean. Long-term investing and wealth building could help alleviate that stress for all ages and income levels through financial security. It is possible to develop that security through these 4 key steps. Make money. No shit. A consistent source of income. Okay. Get a job. All right, guys, go get a job. Save money. Yeah. Build up your savings like an emergency fund. All right, guys. So your savings should be an emergency fund. Always have an emergency fund. You can also build savings for other things if you're going to buy stuff in the next year to 3 to 5 years. Don't put that money in the market. Use that money and put it in a savings account if you're going to use it in the next 1, 2, 3, 5 years, that type of thing. After that point, once you build up your emergency fund, at least 3 to 6 months, if not more, whatever you are comfortable with. Again, if you have a pretty solid job, you could probably get away with less. However, if your job is very uncertain, you work on commissions, that type of thing, you might want to have at least a year's type of savings and emergency fund just in case something happens and you lose your job. At that point, number 3, invest money. Start to invest for potential returns. And then once you start getting there, you might want to manage your money. I don't know why manage your money is actually here. That probably should be, right in here. Because manage money. As you continue your financial wellness journey, you'll need to manage your money through spending, savings, investing, and borrowing. Almost like what you would do right here. I don't know why they put that. You could open credit cards, become a homeowner, and go through dozens of other financial changes. Again, you could do this right here. And when it says open credit cards, if you're using credit cards responsibly and not paying interest monthly, credit cards are a great thing. We can talk about credit card churning if you want, and rewards and all that fun stuff. I love to do it. I did it for years. I don't really do it now because I'm buying another house very soon. So I don't want to mess with my credit score. What are the different types of investments? All right, we're just going to break it down, guys. There's a bunch of them. Securities, any financial assets that can be traded. An asset is any valuable good classified as durable or useful over time. The one that we hear about all the time, especially on the stock market, is, maybe stocks? Stocks, a security that represents ownership in a company sold by a firm to an investor or shareholder. The business then uses the money to fund operations, and the investor receives dividends or fiscal rewards based on the company's performance and earnings. Bonds is a type of debt security. An investor or creditor funds someone else's loan in return for an interest or other payments. Unlike a stock, a bond doesn't represent a stake in a company. It's a stake in debt, basically. Mutual funds are a type of investment fund or pooled investment vehicle. Third-party financial investors use money from multiple investors to purchase a range of different security types. Usually, they charge fees. Mutual funds used to be a big thing back in the day, and they were really important, especially with people like Dave Ramsey's. But let's be real, mutual funds are not that great. They charge a lot of fees for nothing. If you're smart, you would go get index funds or exchange-traded funds. Don't worry about mutual funds. But again, if you're old school and a boomer or millennial boomer like me, I used to have mutual funds, and I feel embarrassed to tell you that. I don't use them anymore because they're stupid. But again, if you guys want to be easy and have someone else manage your money, just do mutual funds. Who cares? Index funds. This is where it's at. If you want to be safe and very conservative with your money, get index funds. Index funds are mutual funds that adhere to predetermined rules, which make it easier to track specific classes of investments. So something like the S&P 500, the Dow Jones, anything growth. No, that's an ETF. I don't even know. There's a bunch of different index funds, but basically they track a certain type of a category within the market. Again, S&P 500, VU from Vanguard is a great index of the S&P 500. So I like specifically myself, again, I'm not telling you how to do this. This is up to you if you want to get into it. But exchange traded funds, ETFs, they're like index funds that gets traded like stocks on exchanges. So you can buy them throughout the day versus mutual funds, which usually you can only buy in the morning or the evening of a day. Exchange traded funds are traded throughout the day. But again, they track either something like an index. They can track something like a mutual fund, like growth aggressive growth, energy sector. There's all sorts of types of ETFs. It's unbelievable how many there are nowadays. There's even ETFs for cryptocurrencies, and they suck. It's Bitto, and it's horrible. Don't buy it. I own a lot of it. It's stupid. And by that I mean I only own like a handful of it. And I lost about 55% on that. Options are instruments based on prospective transactions. These are contracts basically that let investor reserve the right to trade in the asset at a later date and a given price. Options take a while. Don't be investing in options this early in the game, especially if you're a beginner. Even if you're an intermediate, wait until you get to the advanced level, because options are definitely tricky and it takes a lot to explain. So we're just going to stop here. Just don't do it. Be smart. But again, don't listen to an idiot on YouTube on what you should do with your finances. I'm the idiot. So don't listen to me. Do whatever you want, but don't do it. Retirement accounts. These are IRAs, 401ks, and these are all examples of tax advantage retirement plans. Again, it's tax advantage. That's why it's great, but mostly you can't use these or get into these type of fund. Well, you could start it, sorry, but you can't actually pull from these funds until later in life, late 50s and mid 60s, that type of thing. So again, these are very, very long term. They're for your retirement. Again, those are IRAs and 401ks. Real estate investments. Purchase of tangible land or property, such as personal homes or commercial lots. Real estate is its own subtopic. There's so much that you can do with real estate, guys. But basically, you're buying land or a property, and it could be a home or a commercial lot. But again, there's so much more to it than that. But this is just the basics overview, so we're just going to stop there. There's notes. There's flipping houses. There's wholesaling houses. There's a lot. There's a lot to real estate. The REITs even. Alternative investment. These are investing in startups or venture capitalists. As a venture capitalist or getting involved with hedge funds. There's a lot more than that, but alternative investments. And then a portfolio is a collection of investment assets, basically. So jumping into alternative investment options, cryptocurrency is one, obviously. It's very difficult to value because it's very volatile and it's very new. Cryptocurrencies are insane at the moment. Everything's down at the moment, but like there's so much hype behind it. There's so much going on with crypto. It's not just about cryptocurrencies. It's about smart contracts. It's about NFTs. There's a lot going on. So again, it's very difficult to value, and they're also very new. Very new. They haven't been proven, most of them, at all. Except maybe Bitcoin, because it's been around since 2009. Real estate investment trust, again, REITs, real estate investment trusts. It's a public or private company that owns property to create income. REITs typically assume the responsibility of the operations, and then equity is to the ownership of mortgage, and they can be traded as on the exchanges. So that's a cool thing about REITs. So if you want to get in real estate without actually owning it yourself or doing all the work yourself, you can always look into REITs. Again, they're traded like ETFs on the exchange. Commodity. It's a service or good whose units are fungible and interchangeable in terms of contracts, similarly to stock options. Soft. Agricultural goods such as grain. Hard. Goods that come from mineral exploitation, such as iron ore, and then energy. This includes electricity and fuel sources. Precious metals. Have you ever heard of gold or silver? There are hard commodities. They are precious metals. Of course, holding a lot of coins and gold certificates may not be convenient. So this is a way. There's multiple ways to get into precious metals. I don't really cover it a lot because I don't really believe in it and care about it anymore. Because at the end of the day, you just make way more money elsewhere. But if you want to have a safe haven, you want to hold on to some gold and silver, there's multiple ways to do it. You can do it through actual owning gold and silver, like physical in your hand. You can do it with certificates. You can do it with ETFs. You can do it with mining companies. There's all sorts of ways, guys. Hedge funds and private equity. A hedge fund is a managed fund that receives capital from an institutional investors and those with high enough net worth. Guess what? If you're watching this video, you're probably not going to be buying the hedge funds because you're learning about investing. You should already know this if you're rich, but we're not. And that's why we have to study stuff on Google and YouTube. Private equity investment funds are limited partnerships, typically for venture capitalists or independently wealthy. Again, we're probably not here yet. We're probably here if we're lucky. All right, cryptocurrencies. Crypto is so much fun right now, if you haven't noticed. Cryptocurrencies, so think about Bitcoin or Ethereum. Those are the top two. They're pretty great. Obviously, if you want to invest in them, invest in them. If you don't. They're digital currencies and are relatively new classes. They're on a decentralized network powered by blockchain technology. They're definitely less regulated than traditional stocks or asset classes and can be very volatile investments. That's why I don't recommend crypto except for a very, very, very small portion of your portfolio, like 5%, 10% max. And that's if you just want to have fun. It's wild, wild west, guys. Come on. So just be smart with your money. 5 steps to take before investing. First of all, you gotta establish your goals. You gotta know what you want to do. Why are you investing? What for? Retirement? For fun? To buy a house? To just make money? Are you trying to day trade? Why are you investing, guys? Come on. Think about what you want to invest. What are your financial goals? Do you want to do home ownership, a rainy day fund, travel, retirement, or anything in between? Make your goals specific and measurable, and then consider your time horizon. How long do you have until you like to achieve that goal? Build a savings strategy. Start with your emergency fund. Avi, come on, guys. Always have an emergency fund just in case. And then don't be dumb, because I've invested in my emergency fund before, and then I lost it. Don't do that. But my job is very stable, so I was able to make it back very quickly and save again. But don't be like me. Be smarter than me. Start with your emergency fund for your savings, and then don't touch it. It's for emergencies only. Aim to save 3 to 6 months of living expenses. If you can, try to save at least 15% of your earnings. A simple way to do this is automatically sending that 15% of each paycheck to a savings account. It's an allocation. It's super easy to set up. Just send at least 15%. Obviously, if you can't, 10%, that's the ideal one too. Or more. Definitely more than 15 is great. Look at your goals, begin calculating how much you need, and then how much you have each month to invest. Then you go. Number 3, calculate the amount to invest, how much you want to invest. Build a budget. Budgeting helps you stay focused on track. Again, I don't know why they put it here. You should probably start a budget like at number 1. And by that, it doesn't have to be specific. It can just be very vague budget, but just stick to it. You can always do a simple spreadsheet or a very detailed color-coded masterpiece. It really depends. If you're ADHD like me, a simple spreadsheet works. If you're very OCD like most of the people in my family, a detailed color-coded masterpiece might work well. Budgeting is essential for several reasons. 1, it helps you identify your money habits. Number 2, it keeps you focused on your goals. 3, it removes the stress of not knowing where your money is going. So pretty much this is stupid. This is the most important part. These are still important, but this is the most important part because you get stressed about money, right? That's the whole point. That's why you're watching these videos. Come on, guys. Follow along. Number 4, understand your risk tolerance. Risk tolerance is defined as an investor's ability and willingness to withstand volatility in the stock market. Investors who have never weathered a market downturn before, it is difficult to pinpoint exactly where you would likely react. Let's be real. Most people starting investing are very, 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 very conservative. You want to invest in the most solid, safe things. I've been through a couple stock market downturns, especially crypto. So that's not stock market, obviously. So I was through the 2008 bubble. That was super fun. The 2021, that was super fun. And then, the 2022 one, that's super fun. And then with crypto, I didn't actually get into crypto until about 2017. So that was a super fun bull run. And then it just bear market. So this is my second crypto winter. And it's very exciting because I'm going to make a lot of money off of this one. I know it. So again, when you're first starting out, you don't know your risk tolerance really. So invest in solid companies and solid assets. Don't be dumb and get into all the hype. because at the end of the day, you don't know what's going to happen tomorrow. COVID could hit, or crypto winter could hit. Winter is coming. It's already here. For your risk tolerance, the question really is, how much are you willing to put on the line to do it? And how much will your emotions rule our decisions if the account value plummets? Don't let your emotions get into it, guys. Remember, have a plan. That's the whole point of having all the goals, is to have a plan. If you want, you can go to the article and you can check out your risk tolerance quiz right here. I'm not going to click on it. You guys can click on it if you want. I'll put it in the description for you. In our social first world, investing advice is often fueled by media, financial influencers, and online communities. Again, don't listen to idiots online, especially YouTube, like myself, because that's the problem. Don't take advice from people online. Again, like myself. Do what you want to do, guys. Don't be pressured into buying or selling things because everyone else is doing. That's the whole Chicken Little thing. The sky is falling, and then you sell all your stuff at a loss when it was just a dip. Like right now, everyone go buy the dip right now. Again, don't listen to me. Do whatever you guys want. You guys are free people. Do what you want. Social channels, along with new fintech app, are teaching and influence people more to invest than ever before. They also popularize some risky practices like short-term trading and drive groupthink among retail investors. Again, I definitely don't tell you guys to get into crypto or anything short-term like swing trading or day trading. I do it for fun, and again, it's a very small part of my portfolio. If you want to gamble and speculate and do all that fun stuff, do it. That's up to you, but I definitely don't recommend it to literally anybody ever. Investing is, again, for long-term generational wealth. Be smart with your money, guys. Remember, there is no magic pill or button that you will give you results you want quickly, except crypto. I'm just kidding again. Don't be dumb. Reliable plans, habits, and technologies can support your investment goals over time. Again, that's the point. It's over time, very long term. 5. Learn common investing mistakes. Believing any investment is a sure thing. Even gold is not a for sure thing. Nothing is. Look at Lunaterra. That was a for sure thing, and that's not working. Paying too much attention to short-term noise. Blindly taking advice without doing your own research.